I think you all can see this particular document.
Can see, sir.
Yeah, previous day we completed the balance part of investment income. Then thereafter we started the business income. Now today we will continue from that point onward. Right. Before that, I think somebody wanted me to explain the associates, the term associates, which is a bit difficult to understand. It is there in the section 196. Section 196. I just copied down that document. I'll open the content in the act. I'll open the content in the act. I have just copied down that section as given in the act. Now, associate person. Section 196 explains the associate or associated persons. Right. Now, as I explained that day, first subsection 1, 196 subsection 1 mainly refers the individual situation. Mainly individual situation. Then the subsection 2, any person is covered. Now we'll see subsection 1. It says, for the purpose of this act, two persons are associates or associated persons. Associates or associated persons, right? Two persons are associates or associated persons. Now this is, I just copied down from the act, that's all. Where relationship between, now we are trying to find out the relationship, right? Now we are, this analysis is based on a relationship. Relationship between two is, there are 4 items in it. There are 4 items in it. Now we will see these 4 items. We will see these 4 items. Yeah, we will see. Yeah. Relationship between two is that of an individual, that side individual, and a relative of individual. Relative of individual. Individual and a relative of individual. Right? Then number 2, B, that of partners. They are covering partners in a partnership. In a same partnership. That means among partners in a partnership are, when we take all partners in one partnership, are associates, not in different partnerships. Then number 3, that of an entity doesn't include individual. Entity includes only other persons, other than an individual. That of an entity and a person, As you know, person includes all 4 categories. All 4 categories included in persons, but entity doesn't include individual. Therefore, entity includes only 3, referred to in subsection 2. Now, later we will see subsection 2. Now, first one, individual and a relative. Second one, partner
Partnership.
and other partners of a partnership. Third one, C, entity and a person referred to in subsection 2. Or, conjunction here, the conjunction is or, in any case not covered in paragraph A to C. If it is not covered in A to C, such that one may reasonably be expected. One may reasonably be expected to act other than as an employee in accordance with the directions, requests, suggestions, or intention. Now, this other than an individual, the employee is also important. Now, obviously, an employee has to obey to the instructions. Now, here, employee is removed. Other than an employee, any other person, if any other person is acting on instruction of somebody else, directions of somebody else's request, somebody else's suggestions, right? Somebody else's intentions, then those two persons are associates. That means there's a person who is giving instructions, directions, requests, suggestions and all. Then another person is acting according to that. Then those two persons are associates. Now, when we take politics and all, there are so many people who are acting on the intentions of those politicians, or politicians may be acting on the intentions of the voters until they win anyway, right? At least until they win, right? Then that type of, if one person is acting on the directions, requests, suggestions, or intentions of another person, these two persons we consider as associates, right? Other than employees. Next. Now here, the C item even covers entities, right? Now we will see B, the second item. A person and an entity, a person and an entity are associated persons where the person controls the entity or may benefit from 50% or more of the right of income, capital, or voting power. The person, now here the person controls. The person includes all four categories. Now here what is happening? Controlling. This particular person is controlling. Controlling what? An entity. The second category, only 3 categories are there in this, individuals are not there. But here in persons, the individuals are also there. The person controls the entity. This person may be a director or may be another holding company. This may be a holding company even, right? Controls the subsidiary company, something like that. Or individual director controls a company or may benefit. Now here, one important thing is controlling, controls. The other one is may benefit. Now may benefit. That means now under two criteria, they have measured this. One is controlling ability. The other one is profit sharing ability, like benefits. Benefit, right? Benefit. from 50% or more of the rights to income, capital, or voting power. Now, this first part controls. Second part has a right to the profit and all benefit. What's the quantum of these rights? Quantum of ability to control and the quantum of this benefit enjoyed. 50% or more of the right to income. One item is right to income, right? Or capital, right to capital. That means you are a shareholder more than 50%. Or voting power, right? Even you are having lesser shares, you may be having more voting power of the entity. That means now the second party has to be an entity. First party may be an individual or an entity, either case. Right. Then it explains further. Now this controlling or getting benefit right, by which way? Either alone or together with persons who under another application of this section are associated with the person. Either alone or together with other persons. That means solely or as a group or connection. No problem. Both are covered with this. Under another application of this section are associated with the person. Right. And whether directly, now it says whether directly or through one or more interposed entities, through one or more interposed entity, that is indirectly, directly or indirectly. Then again, now here the conjunction is O. That means now this subsection 1 ends with a full stop. Now see, subsection 1 ends with a full stop. Subsection 2 ends with no, it is also with full stop. But item 1, item 2A is separately they have considered, or they have considered that separately. Why this is not serially, this is B. Something has happened to that. When I'm copied down, computer has given some wrong connection. Right, okay. Right. Or B, the person under another application of this section is an associate of the person referred to in paragraph A. Now, paragraph A, the word person is also there, entity is also there, but this person, this particular person, under another application of this section, may be an associate. Then again, we have to take. That means ultimately what it says is all these are direct as well as indirect. Right? Always direct as well as indirect. Then number three. In this section, Relative is defined here. Whose relative? The word relative is defined in this. Now we have, when we are seeing the word relative, the meaning of relative, we have to read this and understand. Now relative is relating only to an individual. For a company, there can't be entity, there can't be relative. Now the word relative, they have used here. Individual and a relative of the individual. That means this individual's relative also has to be an individual. Now the relative is defined. In this section, relative in relation to an individual means the individual's child, that's subject to the individual's child, spouse, parent, grandparent, grandchild, sibling, aunt, uncle, nephew, niece, or first cousin, including by way of marriage or adoption. Any of these things are covered with that. Now, this is the definition, right? Now, with the definition, in the case of individuals, all relatives, now see this relative, it has gone into 3, 4 generations. 3, 4 generations. Child, parent. For me, the parent and child. That means 3 generations. Then grandparent, 4 generations. Then grandchild, right? 5th generation, right? 5 generations are covered. Grandparent, parent, child, own self, then child, then grandchild, then siblings, right? Then others are indirect connections, right? All of them comes under the category of relatives, right? Is this clear? Is this clear?
Yeah, it's clear.
Right now, for each case, when you are applying this, you have to apply this very carefully, right? Because it is so complicated, right? Therefore, case by case, you have to apply. Now I'll move to the original note. That day we discussed the business income, right? Now, I'll move forward. Give me a minute, please. Yeah, we will move forward. That day we discussed the definition of business, the speciality of the definition of business. To be a business, it has to have a business character, right? If there's no business character, that means there's no business, right? To be a business, the business character is so important, right? Then that business may be the current business, past business, or future business. Then generally it says these things to be included. then it says excludes. Under exclusions, exempt and final withholding payment items are excluded. That is there in all income sources. Then second one, amounts included in calculating person's income, employment income. Right. Then general allowables we discussed. Section 11. As per section 11, it says, in calculating person's income from business or investment, for both cases, expenses to the extent they are incurred during the year, incurred, one condition, during the year, the other condition, by the person is the third condition, then for the production of income is the fourth condition. From the business or investment shall be deducted. If you fulfill these four conditions, incurring, during the year, by the person, and in the production of income. If you fulfill these conditions, then that is a allowable expenditure for income tax purposes. Allowable expenditure for income tax purposes. Now we'll move forward. Right. Then there's a general rule. There's a general rule which says no deduction shall be allowed on capital nature unless it is specifically mentioned that it is allowable. If it is specifically mentioned that it is allowable, no problem. In any other case, those expenses, cost of funds of the capital nature costs are not allowable, that we discussed. Then we said we have to follow generally accepted accounting principles, that mean accounting standards also cover. Then certain disallowable expenses we said under section 10, all of us know, things like domestic expenses, any tax under this act, then any fines payable to the government on breach of written law, then any other specifically expenditure and other deductions connected with exempt income and final withholding payments, then dividend of a company, because dividend is a distribution profit, then retirement contributions, subject to some conditions, then entertainment expenses, then reserves or provisions, not accrued expenditure, the things which are not incurred. Then in the case of lottery winning, the expenses, then any other levies specified by Commissioner General, those are not allowable, or in terms of any other law. Then we discussed that there's a new section, section 10, subsection 2, 3, 4 are there. Then in between that, they have introduced a new section, subsection 10, section 10, 2A, effective from 8th May 2023. Now, this is to limit cash and open check payments. Cash and open check payments are limited under this. Now, as a result, if you are making any single or aggregate transactions, they use the aggregate any a sum of money amounting in aggregate of 100,000 rupees or more in one day, or in respect of single transaction, then or in respect of series of single transactions, relating to one event, then there are only 5 ways of settling that money. Only 5 ways are there. Account payee check, account payee bank draft, credit cards, debit cards, electronic payment methods. Only those ways are there. Then this rule is not applicable to government and governmental institutions. Further, it is not applicable for banks and financial institutions. Banks and financial institutions. Then in addition to that, finance minister, the finance minister can list, prescribe any other exclusions. Then we'll move forward. Special allowables. Now this is very important in tax law, section 12 to 19. Though we call these things as special allowables, actually some of these are special conditions. These are not really special allowables, not only the allowables and also conditions. Allowable of claiming. Some conditions of claiming. Right. Now we will see one by one. Section 12. Section 12 covers interest expenditure. Section 12 covers interest expenditure. What it says, interest is allowed only if the finance facility is utilized during the year or previously in production of income. Interest is allowed only if the finance facility is utilized during the year or previously in production of income. Right. Now, under this, suppose a company obtain a bank loan and given that money to the managing director for him to buy a house. Free of charge, giving a loan to the managing director to buy a house. Then in that case, whatever the interest paid by the company to the bank is not allowable. It's not allowable. Why? They have not utilized that facility for the business purpose, production of income. Then, earlier, this during the year or previously section was there, but subsequently, they removed that part. Now, what has happened? Suppose somebody, at that time, as per the law, a company obtained a loan in 2023-24, obtained a loan from the bank and utilized that money for working capital. 23-24, utilized for working capital. 23-24, they reduced the working capital and given that money to the managing director to buy a house. That means subsequent year, not during the same year, but subsequently utilized for something else. Then in that case, earlier there was a loophole. There was an opening for people to do manipulations. Just to match with the law, you obtain law in current year, subsequent year you utilize it anything other than the business purpose. But now, as they have removed this, you can't do that. Is it clear? Are there any questions?
It's clear.
Are there clear? Right, okay. Now we'll move to the next item, section 13. What section 13 says? Section 13, allowance for trading stock. What the law says, you have to take the brought forward stock and add the purchases during the year, then deduct the carried forward stock and arrive the cost of sales. Now, the tax law is trying to educate us how to prepare a working account. We know that, but tax law is saying this is how you should do that. I think what may have happened now, this particular tax law, they prepared for the country Ghana, for the first time application of income tax. Therefore, when they are introducing a tax law for the first time, they wanted to explain everything. Even they explain how to prepare a working account. That is why, that is this. Start with the opening stock, add the purchases and deduct the closing stock. But in our case, actually, we need not to learn these things from a tax law. Right? But they have included that part also into our law for the first time. Earlier, this type of things were not there in our law. Right. Anyway, this is the normal working account, profit and loss account. First part of profit and loss account is explained in here. That is section 30. Now we'll move to section 40. Improvements on depreciable assets. Improvements on depreciable assets. Now improvements, this particular improvement may be capital nature or may be revenue nature. This particular improvement may be capital nature or may be revenue nature. Whether it is capital nature or revenue nature, either case, whether it is capital nature or revenue nature, this is applicable. Now, originally, first we'll read it. Original thing, repairs and improvements, whether it is capital or revenue nature, on depreciable assets, are deductible subject to some upper limits. That means that is why I changed this heading also, conditions of claim in some condition. This is a condition. They have introduced an upper limit. That's a condition. Right. That's an upper limit condition. Now, after with these wordings, there was a problem. Now, when an asset is getting older and older, we need more and more repairs. We need to do more and more repairs. Now, therefore, when you limit this claiming facility, it is not fair. It is very unfair. Therefore, after realizing that it is very unfair, they removed the wordings after pointing out that the situation, they removed the word repairs from this. Now, for repairs, no limitation. If there are repair expenses, you can just claim the entire cost. But improvements, when you say improvements, obviously, along with the word improvements, it gives some idea, indication that it may be even capital nature. Right? When it takes improvements, it may be even capital nature. Generally, it looks like capital nature, but even revenue nature may be there. But now they have given this condition only for improvement. In a way that is fair, because most of the improvements may be capital nature, right? In a situation like that, upper limit of claiming is up to a limit, up to a level, it is fair, right? Then, however, with effect from 1st April 21, the maximum limitation of claiming of expenses is applicable only on the cost of improvements, right? That is what I explained, right? Now, what are the limitations? On buildings, up to 5% of the written down value. In the tax law, it says written down value. When in the tax law, it says written down value. When the word written down value is given in the tax law, it says written down value. Then obviously, then that written down value indicate the tax written down value. It indicates the tax written down value, not the accounting written down value. As you know, for tax purpose, as you know, there are two types of written down value: accounting written down value and tax written down value. Here, we have to take the tax written down value. Okay, tax written down value. On buildings, that means if this improvement is for a building, now we'll say we had a building for years and now the outer appearance is not up to the level. Outer appearance is not good. Therefore, we thought of improving the outer appearance. For that, what we did, we covered the front walls with cladding sheets, aluminum cladding sheets to give a new look. To give a new look, we covered with aluminum. Now it's an improvement. All the bathrooms were not up to the good condition. Therefore, we removed all bathroom fittings and fixed new bathroom fittings. Right? Right. Then those are improvements. Now, when we do this type of improvements, suppose the tax written down value of the building, is 10 million. We incurred 1 million this year to cover the walls with cladding. Now we have to calculate 5% of that 10 million tax depreciation value of 10 million. We have to calculate 5% of tax depreciation value of 10 million. Right. 5% of 10 million, 5% of tax written down value of 10 million is only 5 lakhs. Therefore, in the current year, we can claim only 5 lakhs. Current year, we can claim only 5 lakhs. Then what's happening to the balance 5 lakhs? We incurred 1 million. Then balance 5 lakhs, we have to carry forward to the next year by adding to the cost of the asset. That means balance amount, we can't just carry forward and claim in the subsequent year. We have to take that 5 lakhs as building improvement asset, a separate asset called building improvement asset. Even the year you can mention, building improvement during 24-25 asset. In that, we debit that 5 lakhs into that account. Then that building improvement, you have to depreciate yearly for tax purpose. Now, this has created lot of issues. Now, see, excess amount we have to add to an asset, a separate asset, and do that. Because we can't just add to the building, because building, now we'll say almost 12 years depreciated. Now, if we'll add this 5 lakhs into that, ultimately, during next 8 years, we can't claim the entire 5 lakhs. That is not fair, no? Therefore, that we can't do. Ultimately, this law, which is not much practical, impractical law, we have to create another asset. We have to create another asset and keep this 5% for us to keep this unclaimed amount as a depreciable asset. As a depreciable asset. Only thing what I can't understand, why the legislators couldn't understand the repercussions of this. A lot of repercussions are there. But it's a usual thing. In countries like ours, legislators are clueless. Ultimately, the legislators are clueless. Therefore, they just copy down something from some other country, come and install those things in Sri Lanka, whether it is suit with our situation or not, because generally they don't have that much of experience or practical abilities or knowledge to understand whether it suits with our country. Now, this is a law like that. Just to get the IMF facilities, at that time, government blindly accepted this law. That is what has happened. Even now it is happening, earlier also it happens. No difference. Right. If it is any other asset, the rate 20% rate is applicable. Any other asset, 20% rate is applicable. Right? Any unclaimed excess cost, as I mentioned, to be added to the cost of the asset. Now the law says to be added to the cost of the asset for claiming capital allowances. But there, if you just blindly add to the cost of the asset, building, which is already depreciated for 12 years, we'll say. Ultimately, next 8 years, you are depreciating the building, then left with something which is not depreciated on this new one. Therefore, for tax purposes, you have to identify it as a separate asset. Even it says to the cost. It says to the cost. I think this is an error in the law. Added to the cost of the asset. The cost of the asset. Now this is asking for troubles. I think it's an error in the law. Right? But in our case, for all cases, what we do, we create a new asset called building improvement 2024-25. Separate asset. Then that asset you can depreciate for next 20 years. Then with effect from 1st April 2022, with effect from 1st April 2022, if the subject asset written down value is 0, if the subject assets written down value is 0, the improvement cost be claimed as follows. The improvement cost be claimed as follows. Now, with effect on 1st April 22, if the subject assets written down value is 0. Now, what has happened? With this rule, suppose the building's written down value, building is old more than 20 years, what will happen? Written down value is 0. Now, in a situation like that, there's no way of claiming. After pointing out this original act, this error was there. Then we pointed out that this is wrong. After pointing out, they rectified it. What it says, with effect from 1st April 22, if the subject assets written down value is 0, the improvement costs be claimed as follows. How? If it is building, because the base is 0, then when you apply that limit of 5%, the answer is also 0. Therefore, it says, no, you need not to apply 5%. You just take 1/12 of the amount as per year. Claim within 12 years of assessment. Claim that amount within next 12 years. On other assets, within 3 years of the assessment from the year of the assessments, from the year of assessment, the expenditure incurred. Any depreciable assets other than buildings, then you have to claim within 3 years, next 3 years. If the written down value is 0. Are there any questions on this? Are there any questions on this? You all may have faced lot of issues on this section as a result of this section, because it created a lot of issues. Anyway, after pointing out, twice we managed to get it amended.
So
Still, to the cost of the asset, that error is still there. Still that error is there. Next, research and development expenses and agricultural startup expenses. Research and development expenses and agricultural startup expenses, and this is under section 15. Now, research and development. Generally, most of the research and development expenses are capital nature. For unseeable the future, we are spending this money, right? Therefore, it is more capital nature. Most of the things are capital nature. And agricultural startup expenses incurred during the year by the person and in the production of income may be deducted. Maybe, see, the wording is maybe. This is very important. Not shall be, maybe deducted irrespective of capital or revenue nature. That means generally when we take research and development expenses and agricultural startup expenses, both these things more towards capital nature. As a result, it says whether it is capital nature or revenue nature, no problem. You can, if you wish to, you can claim it. If you wish to, you can claim it in the year you incurred the expenditure. In the year you incurred the expenditure, you can claim the entire amount. Now, as an example, if I'll take example like this, I'll take an example of, we'll say a freshwater fish rearing business. Freshwater fish rearing business. Some people, ornamental fish, especially ornamental fish. Lot of people, they prepare separate tanks for ornamental fish. Because some occasions, if you grow them in mud tanks, the color goes off. Therefore, you need fresh water, the clean water. Certain fish, of course, you need even muddy water, no problem. Then you can have mud tanks. Then you grow in these tanks. To grow in these tanks, in the first year, you have to build these tanks, which cost a lot. It's not easy. It costs a lot. Then after spending that cost, only you are getting this. That means definitely this is capital nature. When you spend that money, you will be getting the benefit, which is spread over a period more than 1 year. Getting a benefit more than a period, spread period more than 1 year. Then capital nature. Under this, you can claim those things. However, under section 15, the cost capitalized into the asset. The cost capitalized into the asset cannot be claimed in the case of research and development. Now, in the case of research and development, some costs you may be capitalizing, putting into PPE. To do research and development, we'll say you imported lab equipment. You fix the lab equipment. Then you capitalize the lab equipment. If you have capitalized the lab equipment, again you can't claim it here. Then you have to claim depreciation allowances, right? But as it says may, even for accounting purposes, you capitalize. What you can do, let the accounting purpose capitalization be there. But for tax purposes, you take it out and claim under this in the first year. Once you claim in the first year, you can't enjoy capital allowances. Then, but no such an indication for agricultural startup expenses. In the case of agricultural startup expenses, no indication like that. That means that is also an error. It looks like, now we'll say we build concrete tanks for fish rearing business, concrete tanks. We have gone and capitalized the concrete tanks as an equipment. Now, when we capitalize it under PPE as equipment, for tax purposes, we are entitled to claim 20% depreciation allowance because it is not a building. It is not a building. Therefore, we can claim depreciation allowances. Right. Then, it looks like that we can charge in both places. Under capital allowances also you can claim, under section 15 also you can claim. This is an error in the law. I don't think you are permitted to claim in both places. It is not correct, right? But law, it has an error. Then further, on research and development expenses, there was an additional deduction of 100%. That may additional deduction of 100% mean original section 11 deduction plus additional deduction of 100% revenue part. When we take revenue part, under section 11 also we are claiming it. That means additional deduction of 100%, that means 200%. Under 6th schedule, during the period 1st April 2018 to 31st March 2023, only during that period. Thereafter, it is not there. Thereafter, it is not there. Then next item, 200% deduction facility for marketing and communication expenses. This is very, very important. 200% deduction facility for marketing and communication expenses under section 15, capital A. And item 10 of the 6th schedule. Right. Now, this facility is there in addition to the section 11 deduction. Now we'll see what it is. Ultimately, section 11, we are claiming once. Under section 15, we are claiming 15A, we are claiming 200%. Ultimately, 300% of the expenses we claimed at that time. At that time, we claimed 300% of those expenses. Right? Now see the benefit what we got at that time. There was a huge benefit at that time. 1. As per section 15A, in calculating a person's income from business, any person shall be entitled to deduct marketing and communication expenses irrespective of capital nature. Whether that is capital nature or revenue nature, you can deduct the marketing and communication expenses irrespective of capital or revenue nature incurred by such person in the production of income. But only thing, you should be in a position to prove that incurred in the production of income, right? Incurred during the year, then during the year of assessment. Those conditions are also to be fulfilled. Then you are eligible to claim, were eligible to claim 200% allowance under 15A. Then again another 100% if it is revenue nature under section 11 also. Then part 2. Further, there was an additional 100% deduction under item 10 of the 6th schedule on marketing and communication expenses, whether capital or revenue nature, incurred during the period from 1st April 21 to 31st March 23, when calculating income from business for the year of assessment. That means only during that period, it is required to follow the requirements given by the Government Gazette 2258/18 of 14th December 2021. There are conditions in that. Subject to those conditions, we were permitted to claim these capital allowances, right? Or not capital allowances, it's some type of allowance. Now, ultimately, so many deduction facilities were there, right? So many deduction facilities were there. Because it says further there was an additional, further, right? Then this is the additional thing. Additional thing incurred only during this period, right? Now, what are the marketing and communication expenses? This is also very much important. Marketing and communication expenses means any expense on carrying out market research, any expense on carrying out market research by such person or any institution in Sri Lanka. By such person or any institution in Sri Lanka. Okay, then say on his behalf, then B, the development or production of marketing, advertising, and communication campaign to the extent that such development or production is carried out in Sri Lanka. The development or production of marketing, advertising, and communication campaign to the extent that such development or production is carried out in Sri Lanka. That means that business, they wanted to give that business to a local party, right? We can't hire an overseas company to do that. That is what it says. In a way, that's good. At least somebody who is in that type of service sector can enjoy the benefit. Sorry. Right. Then next one, product launches or campaign activities carried out by such person or by any local institution on his behalf. Product launches or campaign activities. Now, when it says product launches, normally a product is launching normally in one market. We are launching only once. But again, we may be launching the same product in a different market. That's okay. That is not prohibited. Then the second part, campaign activities. The word campaign activity is not limited to once. The word campaign activity is not, scope is not limited to once. Because you can do campaign activities not only once, in several occasions. Therefore, it is open-ended. Carried out by the person or by any local institution on his behalf. E. Development and printing of point of sale materials by such person or by any local institution on his behalf. Again, this particular service provider has to be a local party. Development and printing of point of sale materials. Point of sale material. Right. Are there any questions here on this? You may be having questions on this because this is very interesting area. If you have any questions, you can ask. Do you have any questions on this? Some examples, some practical questions, what you have? No. Right, then we'll move forward. We'll move to section 16, capital allowances schedule. The capital allowance entitlement. Right, we'll move to that. Allowable depreciation. Allowable depreciation. The capital allowance shall be deducted in respect of depreciable assets. Capital allowances shall be deducted in respect of depreciable assets. Owned and used by a person at the end of the year of assessment in the production of person's income from a business. Production of person's income from a business. The capital allowances shall be deducted in respect of depreciable assets owned. Now there are 5 conditions to fulfill to enjoy this benefit. You have to fulfill these 5 conditions. What are the 5 conditions? Owned and used. You should be the owner and you should use it. Then this asset should be there in the balance sheet date. End of the year, you should be the owner of the asset. Then during the year, you should use it for the production of income. Then from a business, right? You have to use this asset for the business. Ultimately, for investment assets, you are not eligible to claim this benefit. Right? This is very, very important. In the case of investment assets, you are not eligible to claim this benefit. Right? Yeah, this particular asset has to be a depreciable asset. Right? Depreciable asset. You know what is depreciable asset? Which is well explained in section 195. It is explained in section 195. Then you have to refer the section 195 to see whether that particular asset is a depreciable asset. If it is a depreciable asset, under this section, you can claim the capital allowances. You have to fulfill these 5 conditions, then you are entitled to claim the capital allowances. The rates are given in the law. It says depreciable rates in the 4th schedule to the Act fourth schedule to the Act, the depreciation rates are given. As for the fourth schedule, the rates are like this. Buildings at 5%, motor vehicles and furniture at 20%, IT hardware at 20%, plant machinery and equipment at 20%, intangible assets, we have to depreciate within the actual useful time. But if we don't know the useful time, then we have to depreciate at 5% per year. 5% per year. Then sophisticated milking machines to promote dairy industry. They have put these milking machines with latest technology used to manufacture local liquid milk related products. Then with effect from 1st April 2021, you can depreciate, you can enjoy the capital allowances at the rate of 50%. That means ultimately we have 3 depreciation rates, 5% on building and on intangible assets where lifetime is indefinite runtime. Then 50% on milking machines, latest technology milking machines. Then 20% on all other depreciable assets. Then claimable capital allowances cannot be deferred. If you have fulfilled these 5 conditions in the current year, if you fulfill these 5 conditions, you have to depreciate it. You can't wait without claiming depreciation. You have to depreciate it. No option. Now, we'll see what is a depreciable asset. We better see what is a depreciable asset. That's important. We'll see. Depreciable asset means an asset to the extent to which it is employed in the production of income. From a business and which is likely to lose value because of wear and tear, obsoleteness, and of passing of time. Generally, any asset, there's a wear and tear, obsoleteness, and passing of lifetime. That's the usual thing. After considering these things, the asset value might come down or might go up even, because now certain cases it might go up in rare occasion, but generally the value comes down. If it is the situation, it's a depreciable asset. Then specifically it says, but excludes these things. For better clarity, the legislator specified you can't claim depreciation allowances, capital allowances on goodwill, interest on land, membership interest, or in an entity and trading stock. Those items you can't depreciate. Goodwill you can't. Interest in land, like lease interest in land, you can't. Then membership interest in an entity, like you are a shareholder, you are a trustee, you are a partner, that type of things, and trading stocks. Obviously, trading stock is for trading purposes. That's not a depreciable asset. Those four type of items you can't depreciate for tax purposes. Next, if the result of a disposal, now after some time we might dispose it. If once we dispose it, if the result of disposal is a gain, it is considered as a business gain for taxation. Why it is considered as business gain? Because we have already claimed the capital allowances, the cost we have already enjoyed by claiming, as we have claimed the cost as a allowable expenditure by way of capital allowances. Then when you dispose it and gain, obtain a gain, receive a gain, entire gain is taxable as a profit. This is not a capital gain because this is a depreciable asset, not capital gain. However, the gain or loss on selling to an associate do not cover under this section. Obviously, now here we are talking about depreciable assets, not capital assets. Not capital asset held not as a depreciable asset. Therefore, as we know, depreciable assets are not subject to investment capital gains. Right? Therefore, this is totally separated. It is separated. Right? Then enhanced capital allowances. Now we'll move to the next item. Enhanced capital allowances. Now, earlier under fourth schedule, we were discussing about the normal depreciation. In addition to that, there's a special section, enhanced capital allowances. That means in addition to the normal capital allowances under fourth schedule, you are entitled to claim enhanced capital allowances also. Once you fulfill the requirements, upon fulfillment of requirements, you are entitled to claim enhanced capital allowances in addition to the normal capital allowances. These rates, enhanced capital allowance rate may be 100% or 150% or maybe 200%. 100%, 150% or 200%. Additional deduction is granted. Additional deduction is granted on new investment. This benefit is there only for new investments on depreciable assets comprising plant or machinery. Plant or machinery. Right. Now this benefit is granted on new investment on depreciable assets comprising plant or machinery. That means buildings are not qualified, that are fixed to a place. Ultimately, motor vehicles are also not qualified because motor vehicles are not fixed to a place. As a result, even it is a lorry, now you can't claim. It has to be a fixed item. Only plant and machinery, not building, not vehicles. Now this allowance is there under two sections. Section 2, the two schedules. It may be schedule 2 or maybe schedule 6. Now we will see further details on this. Now, the originally it says it has to be a new business, right? Now, on new investment, this has to be a new investment on depreciable assets, right? In the case of a business, the losses on realization of capital assets and liabilities are deductible only up to the extent that the asset or debt obligation of the liability was purchased as an asset in the production of income from the business, and in the case the liability was incurred in the production of income. In those cases, we can claim it. Now, for detailed aspect of enhanced capital allowances, I have given that in paragraph 6.1, we will read it separately. Then, section 17 thing. This section 17 thing is also important. In the case of a business, the losses, now this is with related to losses. Now, losses on realization of capital assets and liabilities are deductible. If it is on realization of capital assets or liabilities, you are eligible to deduct those things. Only up to the extent that the asset or the debt obligation of the liability was for the purchase of an asset in the production of income. If it is only for the production of income, then you are eligible to claim. Or the liability should be for the production of income. That means we obtain a bank loan to purchase a machine. Then the loan is for production of income, therefore you are eligible. Section 70. Now we'll move to next one. Before moving to the next one, do you have any questions? Any questions? Yeah, any questions, please?
So it should be cash basis or accrual basis when we claim the enhanced capital.
Accrual basis.
Accrual
Always
basis.
buy some asset on a loan, no problem.
Oh, no.
That is not at all a problem.
So what are the documents they are checked when we claim the inner revenue
Sorry,
purchase invoice? So
I couldn't follow you properly. What's your question?
what are the document inner revenue check when we claim the enhanced capital allowance?
It has capital allowance. The you should be in a position to prove that you have invested this money. That is one thing. Second thing, you should be in a position to prove that it is a new investment, right? Not an existing investment. Now, when we read this properly, it says not for expansion of a business, right? If it is for an expansion of a business, for any entity other than a BOI entity can't claim enhanced capital allowances. Then the documents are required. You should be in a position to prove. That's all. The other thing, you have to prove that it is a depreciable type of an asset and it is fixed to a place. What has happened originally, some garment factories and all, they registered their new entities in, we'll say, Jaffna area to enjoy 200% benefit. They purchased machines. Some of those machines they kept in Colombo office, Colombo factory. Now, to avoid that type of things, ultimately they said you have to fix it to a floor. But if you put a nut and bolt, that's enough because it is fixed. Nobody can, IRD can't say that it is not fixed. Right? Therefore, still people can do various manipulations. Right? I think I explained that. Do you have any more questions?
So excuse me.
Yeah, please. Yeah, what's the question?
Yes, sir. Now when we are selling a land, say land within a group, last week we spoke that is section from capital gains. Now is it only for lands? I mean investment capital assets. If we sell the say depreciable assets, say a building or whatever within the group, is that also exempt under section 46(4)?
Under section?
46(4), sir?
Yeah, under section 46(4), now, anyway, we will see what it says in 46. Right, now section 46 specifically mention, 46(4) specifically mention, now section 46 is for transfer of an asset to an associate. The wording is an asset to an associate. Then subsection 4 says, where a person realizes an asset, being a trading stock, depreciable asset, an investment asset, or capital asset of a business. Now see, all these things are covered. No?
Yes.
Trading stock, depreciable asset, investment asset, capital asset of a business. By way of transfer of ownership of the asset to an associate, the person and the requirements of subsection 5 are met. The person shall be treated as the realization value is equivalent to the cost. Now, then what is happening?
That means there is no profit.
Yeah, now ultimately there's no profit. Now, no profit situation is there not only for investment assets, but also for trading stocks, depreciable assets, even capital asset of a business. For all these things, this facility is there. For everything, this facility is there. Is it clear?
Very, very clear, sir.
Right, now we'll move forward. Now we'll move forward. Yeah. Financial cost. I think for most of the people, this is a big headache nowadays, right? This is a big headache. Now, IRD is raising so many assessments on this finance cost issue, right? On this finance cost issue, IRD is regularly raising lot of assessments. Therefore, we better think about this. We better think about this. Right. Now what it says, now it says like this. Now we'll read it. It says, financial cost of a non-financial institute company. Financial cost of a non-financial institute company having issued capital are allowed subject to an upper limit. Right. Now, financial costs are allowed of a non-financial institution. Now, under section 11, generally we know financial costs are allowed. As we know, under section 11, financial costs are allowed, right? Because it is incurred in generating production of profit, income. Therefore, it should be allowed. Now, here what has happened? Under section 18, that allowance is limited. Now, the allowance is limited under this. What is the limitation? It says this limitation is applicable for a company, only for a company having share capital. If that company doesn't have a share capital, this is not applicable. If that particular company is not having share capital, this section is not applicable. Now that means under the definition of company in the Inland Revenue Act, the definition of company in the Inland Revenue Act, all associations also comes under the definition of company. Now then, this section is not applicable for any of those associations. Even we treat the association as companies for tax purposes. Now for tax purposes, we are treating the associations as company. Even if we treat the associations as companies, this section 18 rules are not applicable for those companies. That is one thing. Then what about the branch office? Now some of these Chinese construction companies and all, or Indian, they come and do various projects in Sri Lanka. When they are doing these projects in Sri Lanka, everybody wants register companies in Sri Lanka. Some people, they register a new company in Sri Lanka. Some persons, they do not register companies in Sri Lanka. Instead of registering company in Sri Lanka, what they do a registration of an overseas company in Sri Lanka. They go and register their overseas company in Sri Lanka, right? When they register the overseas company in Sri Lanka, for the Sri Lankan entity, there won't be any share capital. For the Sri Lankan entity, there won't be share capital. When there's no share capital in the Sri Lankan entity, these section 18 limitations are not applicable for them. For them, section 18 is not applicable. Why? No share capital. Now, therefore, keep in mind, this section is not applicable for that type of companies either. Not for association, not for guarantee companies registered under the Companies Act, not branch office type company, that is overseas companies registered in Sri Lanka. For any of those things, this section do not applicable. Right? This section doesn't applicable. Now, are there any questions on this? Right? With my explanation, do you have any questions? Right? Do you have any questions? Because I know a lot of people are having a lot of issues on this section. Then there's an upper limit. When we apply the upper limit, whatever the amount what we couldn't claim in the current year, if we'll end up with some amount which we couldn't claim in the current year, we can carry forward that amount to the next 6 years, for us to claim during that period. Whatever the amount possible to claim, we claim in the current year. Whatever the amount we couldn't claim in the current year because of this limitation, we carry forward to the next year for claiming, right? Ultimately, in long run, we may not be losing anything. We might not be losing anything in long run. Might lose or might not, but generally we are not losing, right? Now, we should know what are the upper limits and also what are these financial instruments. Those two are very important. Now we'll try to see those things, right? The upper limit of the interest with effect from 1st April 2021, the upper limit of interest with effect from 1st April 21, we'll see. The maximum interest claim for the year is equivalent to the interest attributable to the debt instrument equal to 4 times of the issued share capital and reserves, right? You can't use the word equity for this, right? Keep in mind the very reason why I have put the word equity and cut it. I know a lot of people, even IRD officials, are also using the word equity. The word equity is not there in the law. The law says share capital plus reserves. For general usage, some people use equity. They're totally wrong. They're totally wrong. Right. The law says share capital and reserves of the company as at the end of the year. Now, share capital. Now, I know IRD is arguing preference shares is not a share capital. They have a silly argument to say preference shares is not a share capital. Now, the Inland Revenue Act, Section 21 says that we have to follow the generally accepted accounting principles in preparation of accounts. By following generally accepted accounting principles and the accounting standards, we are preparing accounts. As for these accounting standards, where we prepare the statement of financial position in that, all preference shares we are showing under the heading of shareholders' equity. Under the shareholders' equity. We never go and show those things under the loan capital. Now, loan capital where we are showing either in the non-current liabilities or under the current liabilities. All loans we are showing under current liabilities or non-current liabilities, not under equity heading, shareholders' equity. Now, preference shares we show under, as by following the accounting standard, we are showing in the shareholders' equity category. But IRD says, no, for this Section 18 application, you have to consider the preference shares as a loan. That is totally wrong, right? Anyway, now there are pending cases on this. There are pending cases on this, which I think it has gone up to the Supreme Court level also. Now we are waiting for the judgment. Now, anyway, to me, IRD's that opinion is totally wrong. Totally wrong. Because what has happened, they have used this general meaning of equity and all. Because in financial evaluation, management accounting. In management accounting, we sometimes take the preference shares into the loan capital. But here you can't do that because here we are not doing any management accounting. We are following the Inland Revenue Act. Inland Revenue Act says you have to follow the accounting standard and the generally accepted accounting principles. We are preparing the accounts by following the accounting standard. When we are preparing the accounts, we consider the preference shares under the not under loan capital. Right. Therefore, it is part and parcel of share capital. If you have any cases like that, don't just give up. Don't just bend to the tax officials. You have to fight for it. Right? You have to fight for it. Right. Saying that, I would like to explain how the computation is to be done. Now, as at the end of the year, you have to take the share capital. That means ordinary shares, preference shares, total share capital. Then you have to add the reserves. Keep in mind, the reserves mean always a positive balance. If there's a negative balance you are showing under the heading of reserves, for tax purposes, it is general purposes also, it is not a reserve. This reserve cannot be negative figures. Now, in our accounts, unfortunately, we show some reserves, retained losses, we consider as reserves. That is totally wrong. Totally wrong. It is not a reserve. Now, the negative balances are not reserves because now if you Google and see the reserve, it's always a positive balance. Right? Therefore, if there's a negative, that means retained loss, you have to take that retained loss as 0 for this. You have to take it as 0. Then capital plus, if the retained earning is 0, negative, you have to take reserve 0. Then share capital, that is preference shares, ordinary shares, entire share capital plus 0 here. You take that value, then as at the end of the year, then you multiply that by 4 times, 4 times of that. That means any loan up to that, any loans up to that value, 4 times of share capital and positive reserves, any loan capital below that amount, the interest on loan capital below that amount is fully allowable. Suppose your loan balance is above 4 times of share capital and positive reserves, then the interest on excess loan is not allowable for the year. Interest on excess loan is not allowable for the year. Then what you have to do, you have to carry forward it to the next year and claim on a subsequent year. You have to carry forward to the next year and claim it in a subsequent year. Right. Give me a minute, please. Yeah, we'll move forward. Then this is the calculation. Then simply, if I'm explaining, interest on loans exceeding 4 times of that share capital plus positive reserve is not allowable for the current year. You have to carry forward and enjoy in the subsequent year. This is the formula. You take the total finance cost, divide the total finance cost by debt instruments, then multiply by 4 times of the share capital and positive reserve.
So excuse me.
Yeah.
Yes, sir. Now, when you say value of the debt instruments, as at what date we take it? Because it's for a period of 1 year, no? Are we going to take the balance sheet date?
No, it's law says at the end of the year. Specifically mentioned as at the end of the year. Therefore, whether you like it or not, you have to take this share capital plus reserve. Always you have to take the balance sheet date balance. No option.
Then so anyone can manipulate on this, no?
Yeah, yeah.
Because
Anyone
we can have loans up to end of say 28th of February, and within next 2 days we can settle the loans and manipulate the whole formula.
Yeah, yeah. People can manipulate. These are the weaknesses in these laws. When they prepare the laws, they have not addressed to these things.
Yeah.
I have
So,
given.
and one more question on the same. So when say share capital plus reserves, say your share capital is always positive. Sometimes there can be instances where these reserves can be minus.
Yeah.
In such situation, how are we going to tackle?
No, that's what I explained.
Yeah.
There's a court case on this. There's a court case you all can search and get download. It is Rajarata Tile Factory versus Commission of Inland Revenue. Samson Group case, Rajarata Tile Factory versus Commission of Inland Revenue. If you'll Google it, you can get it downloaded. In that case, it is handled by Mr. Riyad Amin along with Mr. Rodrigo. Those two lawyers handled it. As per that case law, it is the court accepted, judges accepted, as the term reserve is not defined in the tax law, we have to take the general dictionary meaning of the word reserve. As per the general dictionary meaning of word reserve, it indicates a positive balance. I have a reserve for my older age, right? Always it's a positive balance. Therefore, judgment is in favor of Rajarata Tile Factory. And as per that case, also it is proven that if there's a negative reserve in the accounts, you have to take it as zero. You take it as zero. Is it clear?
Yes.
Right. Now there's a question in the chat box. We'll see. If a house is rented to an individual, by an individual, how is the applicability of withholding tax? Okay. Now, if the tenant is using it for business purposes, or we'll say if the tenant is not using it for business purposes, if the tenant is not using it as for a business purpose, then the withholding tax is not applicable. Why? If the tenant, as an example, now in my case, we'll say my audit firm is a sole proprietorship. We'll say Ranavir Associate is a sole proprietorship. Now how it is happening? Now we'll say I rent one house for 250,000 for the office. Now I am paying 250,000 rupees for my Ranavir Associates office rent. Then I rented another house for 150,000 rupees for me to live. Right? Now, in these two cases, on that office rent of 250,000, I have to deduct the withholding tax. But not on the 150,000 rent which I am paying on my residential rent. On that, no withholding tax. What may be the reason? Right? What is the logic behind that? Why they have legislated like that? Non-business entities. Better not to allow the non-business entities to act as agents of the IRD. That is the principle. Now, suppose I rent a place for 150,000 rupees for me to live. When I am paying rent, if I am to deduct the withholding tax, I deduct withholding tax of 10%, 15,000 rupees. I pay only 135,000 to the landlord. I might not pay this 15,000 to the IRD. I might pocket out that money. Then that means, as I am not a business entity, by allowing me to act as an agent of the IRD, the possibility of manipulating is at a high rate. As a result, they have not gone up to that level. That's the reason. Understood?
Yes.
Always better for me to explain with logic behind the law also, no? The reason why they have designed the law like that. Now, therefore, in the earlier example, I have to deduct the withholding tax only by my Ranavira associates on that rent, not by Ranavira on the residence rent. I think it is clear. Now I'll go back to this one. Now say the interest 120,000 rupees, loan 1 million, equity only 100,000 rupees. That is, we can't say equity, the share capital plus reserve 100,000. Then 100,000 into 4, 400,000 rupees, 400,000 rupees. If we'll apply into this cost, here 120,000. Here share capital plus reserve 400,000 rupees. Here debt instrument value 1 million. Then the answer is only 48,000. We get an answer of 48,000. Out of 120,000, this 48,000 I have to claim in the current year. Balance 72,000 I had to carry forward to the next year and claim within next 6 years. Is it understood?
Yes, sir.
Right. Now with this example, you can just apply it and see. Right? The answer is anyway 48,000. When I apply 48,000, the answer. In computing the eligible claim against the brought forward unutilized finance cost. In computing, the earlier I said certain cases it has gone this preference shares. I know one case, it has failed at the taxpayer failed the case at tax appeals, failed the case at appeal courts. Actually, I can't understand, I can't see any reason for this particular taxpayer loses at the appeal courts level. IRD said that you can't include the preference shares. The main reason is the weakness of the lawyers. It is definitely, it is the weakness of the lawyers. The particular lawyers who handled it couldn't explain and establish the situation at the courts level. You had established the case like I mentioned. Inland Revenue Act says to follow generally accepted accounting principle, which recognize the accounting standard. That means we have to apply the accounting standard. By applying the accounting standard, we prepare the accounts, the financial statement presentations, reporting standard. Then in that, we have recognized as a shareholders equity, shareholders capital, as share capital. Then if it is the situation, law says, that means the Inland Revenue Act indirectly says that you have to recognize it as share capital. Now, if it is the situation, how can they argue that it is wrong? That is the lawyer's devil. Anyway, now, anyway, that is at the Supreme Court level. We'll see the results in future.
Recording in progress.
Hello. Yeah, now we continue. In computing the eligible claim against the brought forward unutilized finance cost in a year where no financial cost is incurred, need to apply the same amounts of the immediately preceding year and so on. That means now in the second year, now this 72,000 we carried forward. In next year when we are claiming, again we have to apply this formula to next year's data. We have to apply this formula on next year's data, subsequent year's data, and calculate what is the possible claim. Now, suppose next year the possible claim is only 60,000 rupees. The answer here is 60,000. Then out of this 72,000, you can claim only 60,000. Balance 12,000 you have to carry forward. Not only that's 12,000, that second year's interest cost also we have to carry forward. This not only this 12,000, but also that year's interest cost plus 12,000 we have to carry forward to the next year. Then the payment made under finance lease purchases. Oh, right now this section 18, now before moving to this section from the 49 special case finance lease thing, do you have any question on section 18? Do you have any practical difficulties what you have met with the IRD on section 18? කාටවත් තියනවද? Section 18 සම්බන්ධයෙන් IRD එකත් එක්කලා ඇතිවෙච්ච financial issues. Do you have any issues with the IRD under section 18?
Yes, sir, we had.
What is the issue?
No, issue was in our case, at that time, we had a big loss. But share capital was a plus figure, right? But finally, what they said was the total share capital plus the revenue reserve comes to minus.
Yeah.
And
You can't
they
claim.
wanted to consider that as zero. So
Yeah. Okay.
that we didn't get any chance to claim even a single cent as interest.
Yeah. Right.
It was
Okay.
not allowed. But it
Right.
was certified by some big audit firms also.
Okay. No,
That's
no,
my
that
practice.
is no. Certified by that system is approved by another
Yes.
consultant.
Yes, yes.
That is what you are saying, no?
Yes.
We shouldn't disclose the names of these firms and all. It is not ethical.
Yes.
Right.
Yeah.
Anyway, another consultant said the IRD stand is correct. That is what you are saying?
Yes, sir.
Now, then what is the step you all have taken by the company? What is the step taken?
Actually, we were not allowed.
And we just believe
Yeah.
the consultant
Yeah,
and the department and be silent.
Yes, sir, because he was our tax consultant and we couldn't go beyond that. That's how it was filed.
Yeah,
So
which
during
year?
those
Which year of
I think
assessment is?
2 or 3 years back, sir.
But
Because that
once,
bad
right,
period. Yeah.
right. Now in the tax computation also wrong. That is what you are saying. When you
Yes, sir.
were in the self-assessment,
Yes.
in the computation, the tax consultant did not allow you to claim this interest. You carry
Yes.
forward.
Yes.
Right. Now, in this particular company, subsequently have they earned profit?
Yes, and now we are okay. Now positive balances
Now,
and now we are free.
currently, are you claiming this?
Yeah, now sir, we have adequate reserves no to cover up the interest.
You are
Now we
claiming.
don't have that issue.
Right. Anyway, what I have to say that originally that particular tax consultant is totally wrong. It's totally wrong. It is error of tax computation, and the IRD is also wrong. Now, what will happen in one day? IRD will, or not IRD, the legislator will give a interpretation to the word reserve, like what they did for agriculture, for VAT.
Yes.
So after some time, they realize that as per the law, any agricultural produce is exempt from VAT. And they were saying that agriculture is manufacturing, not therefore it is liable. But ultimately, after they realizing, when we were fighting, when we start fighting, they went and changed the law. That might happen. Even in this case, in one day, this will happen. They will give a definition to the word, they will give a wrong definition to the word reserve, which is against the general meaning of reserve. They will say reserve comprise positive and negative, whether positive or negative balances, it is considered as reserves. Then thereafter we can't fight. But until they give a definition, a wrong definition like that, they can legalize a wrong definition. That's what's happening now. Then from that onward, it is the definition for this act. Therefore, we can't fight thereafter. Luckily, in your case, subsequent year there's a profit. Therefore, there was no loss. But suppose subsequent years continuously losses, then it's a problem, no?
Yes, sir.
Okay. Next, the payment made under, now we'll talk about the financial lease purchases. Under the old act, financial lease purchases, we were claiming lease rentals as a allowable thing because we recognize the legal ownership. We recognize the legal ownership as common to the tax law also. But under the new act, for the tax law, it is different from the legal ownership. Now, in a lease, legal ownership is with the leasing company until we settled it. But that is why they have right to acquire and seize and all. But for tax law, now they says, okay, even a lease, even a finance lease, you assume it as a bank loan. A finance lease, you just assume a finance lease is equivalent to a bank loan. Then when it is a bank loan, if you obtain a bank loan and buy a property asset, immediately you are getting the ownership of the asset. Therefore, likewise, you assume, the buyer assume that you got the ownership. On that basis, in future, now under the current law, when you purchase an asset on finance lease, even you are not having the legal ownership under the Inland Revenue Act, you are assumed to have the legal ownership. Therefore, you can claim capital allowances on that asset. And you assume that it is a bank loan and claim the interest as a benefit. Interest you claim separately, then claim capital allowances separately. Then the leasing company can't claim capital allowances. Similarly, for hire purchase also the similar treatment to be applied. I think that is clear. Then capital allowances could be claimed by the buyer. In this case, capital allowances could be claimed by the buyer on the fair value of the lease asset. And the seller to be treated as asset disposed. Section 49. Further, payments under any annuity shall be treated as interest and payments of capital under a loan. Now, annuity, when we are making a payment on annuity, even on annuity, we have to separate the capital and interest. That is what it says, right? The further payment on annuity shall be treated as interest and payment of capital. Interest and payment of capital. Right. That is explained in section 31. Section 31, sorry. Section 31 explain that part. Yeah. Do you have any questions? Do you have any questions? Any questions?
So I have one question.
Yeah, please.
In the next year, in particular example, the calculation, if the loan, this value of the debt instrument is 0, that means we have paid during the year.
Yeah.
What would be the amount we can claim from 72,000?
Yeah, that's a very good question. To that question, the law is not addressed to. That means there's no answer for your question. That means indirectly, you can't claim. Right. Now, therefore, it says like this. Now, in computing eligible claim against brought forward unutilized finance cost in a year where no financial cost is incurred. Now, this is how it is addressed subsequently. Originally, there wasn't any answer for your question. Now, after pointing out your question, what they said, now, they included this in 2022. What the newly included one? In computing the eligible claim against the brought forward unutilized finance cost in a year where no financial cost is incurred. Now, in the next year, no financial cost is incurred. Right? Then you have to apply the previous year's amounts and calculate it and enjoy. But now your question, subsequent year, there's no loan at all. Right? Now your question is in subsequent year, no loan. Here 0. Then how to do this? Now that is not properly addressed. What they could have to do is to include that also here. In computing the eligible claim against brought forward unutilized finance costs in a year where no financial cost is incurred, at the same time, they have to say no financial cost or debt instrument as at the balance sheet date, debt instrument as at the last date of the year. Then you should apply the previous year, but that part is still, that part is missing. That's very good question. They have answered part of your question corrected, but part again they have missed. This is how Sri Lanka laws, especially tax laws.
But just a bit addition to that question. Yeah.
Then after creating the law, when somebody else point out this, then you rectify it. Most of this particular act, so many things rectified up to now, but you all can see how many, so many places I have mentioned that it is still error. That means almost about 100 corrections are needed in this act, improvements. Are there any questions? Any more questions? Do you have any more questions? Right. Good. Today, couple of good questions came up with, you all asked several good questions. Very advanced questions, good in the sense advanced questions. Right. Likewise, even next days, please continue to ask more and more technical, practical, good questions. Okay, saying that, I would like to wind up today's session. Thanks, everybody. Good night, everybody. Good night.
Good night, sir.
Thank you, sir. Good night.
Thank you, sir. Good night.
Okay, sir. Good night.
Good night, sir.